Nolan, very good to see you. Today we are talking through how rising interest rates are good news for annuity buyers. The third quarter of 2023 saw record growth in annuity sales. According to LIMRA, which tracks the numbers, total annuity sales reached $89.4 billion. That is an 11% jump over the same quarter last year. One of the reasons why the percentage of workers in the private sector who have a pension is now 4%. That's down from 60% in the early 80s. And annuities can provide that guaranteed income. Explain why annuities could be helpful as part of a larger financial plan.
Sure thing, Erin. So annuities are helpful for the larger financial picture because they help fill in the gap that you just spoke about. So the big gap that you're really trying to achieve when you purchase an annuity is something called your income gap. You're trying to fill in maybe some supplement on top of your Social Security. And this used to be filled by pensions. A lot of people used to have pensions. It used to be the majority, not the exception. An annuity recently has been more used in anticipation of drawing from your retirement accounts because most people's first question is, once I retire, where do I take money from? Annuities are a nice place to take money from. They have good guarantees. There are good growth areas that you can find there, and they have good fixed interest rates as well.
And so, how have recent interest rate hikes made annuities more attractive?
Yeah, like you mentioned, just the growth in annuity sales and placements this year is a huge indicator of it. But the huge thing that happened over the past 18 months is all the interest rate raises that we've gone through. Every time interest rates go up, I mean, it affects all asset classes differently. But one of the asset classes that benefits from interest rate hikes is annuities. So as we had those hikes, as interest rates got up, annuities became more attractive and benefited from that decision that the Fed made.
So, as we look at the different kinds of annuities that exist here, do interest rate hikes only affect fixed annuities?
Well, interest rate hikes actually would probably affect all three of these types of annuities, and for a couple different reasons. Fixed interest or fixed annuities and indexed annuities typically have a fixed interest rate that adjusts upwards based on whenever the Fed increases interest rates. So that's how it really affects the fixed and the indexed annuities. Now, variable annuities are a slightly different animal, and they actually have sub-accounts. These are like stocks and bonds and mixes of different investments. And as we saw in 2022, when interest rates were hiked way up, it negatively impacted bonds. Well, if you have a variable annuity and there's a bond sub-account within that annuity, that bond sub-account likely lost some money in 2022.
Since we don't know what the Fed is going to do specifically with interest rates in 2024, is now still a good time to buy an annuity, or would you consider annuity laddering?
I think annuity laddering is a good decision at this point. And the term annuity laddering is maybe more when you're talking about fixed annuities, when instead of deciding to put all of your money in at once, you're placing small pieces over time. So if you're anticipating rates changing or different asset classes becoming more attractive in the near term, it's usually a good idea not to over allocate into any one individual investment at this point in time. So annuity laddering, taking advantage of current high interest rates, but maybe expecting that they might go up a little bit or at least stay flat, and you can delay your purchase in case you find something better to buy. That can be a strategy you can implement at this point for sure.
Interesting. Well, Nolan, if somebody would like to talk through whether an annuity could be part of their plan, what's the best way to reach you?
Sure. So they can call 616-301-2581 or go to cornerstone-rp.com and fill out the contact us box at the bottom.
Perfect. Nolan, thank you.
Thanks, Erin.